Well, good afternoon. Good afternoon. Thank you, Jeff, for that kind introduction. I am Joe Matthews, and as Jeff has said, I'm a partner with the alternative asset firm Bridgefield Capital. What we are asked to talk about today is, given the current market environment, which is obviously a product of a number of political and monetary factors, what is our strategy for capturing attractive returns on a go-forward basis? So I'm thrilled to do that. And to give our thoughts some context in these areas, let me tell you about Bridgefield and our general approach to the markets. And let me start by telling you a bit of a story that reflects or describes the way that we invest capital. So what I'm holding in my hand here is a daily, what we call an act sheet, that's sent to our firm by a number of investment banks in their trading desks. It comes on every day, and this particular day, nothing special about this day, is November 5th, 2008. About 2 months subsequent to the Lehman Brothers bankruptcy. We're obviously in the midst of the global credit crisis, and remembering back to 2008, which I know many of you do, it was a time that was particularly hard to confidently invest capital. Of course, there were people looking at the equity markets. The market had collapsed. It wasn't necessarily at the bottom yet. I think that came a couple of months later, but certainly it was characterized by significant volatility. But what these daily acts sheets provided or detailed were sellers of banknotes, in this case, banks, insurance companies, CLOs, and other industry participants that were trading out of their positions and the opportunities that were associated with that. And for example, on this trading sheet, what you can see is companies that in many cases had high value assets, companies like Ford or United Airlines, hundreds of other companies across virtually every industry group of all sizes, small, middle market, and large companies. But on this act sheet, companies that were trading out of their, or investors rather, that were selling their bank loans that were secured by these companies for pennies on the dollar, or a share of issued price. And recognizing the way that our bankruptcy code is written, that even in the worst case, if there's a complete liquidation of a corporation, nobody receives value until the most senior positions are paid in full, and that's really what these bank loans in most cases reflect. So if you look at the act sheet, we're looking at companies, most senior positions trading at a fraction of their value. And for example, I mentioned United Airlines. Their senior term loans on this date were trading at 58% to par. And I remember United Airlines. They had at that point in time, roughly a $5 billion market capitalization. They had 12 billion or thereabouts in assets, and the term loans, the pool of term loans, I think were in the neighborhood of $700 to $800 million in value. This, if you apply the 58% to par against that 780 million or so of term loans, effectively valued the company at something in the neighborhood of $400 million. So on this particular day, November 5th, you could have either bought the equity at a valuation that represented $15 billion, and you would have had all of the associated upside alongside that equity, as well as the downside risk if the company had gone to zero and it liquidated. Or you could buy the banknotes that had a potential to double in value of that or thereabouts, again, if the 58% to par appreciates to par, or if the notes are paid at face value, and the alongside a coupon of 10 or 11 or 12%, whatever the current payment was to be made on those notes. Now, you might have had the courage at that point in time, or you might have been the type of investor that had the courage to make the equity investment and make the bet on the future of the company. But I don't necessarily like to have a strong stomach to make my investments, whether it's in periods like that during a crisis or even in periods like today. We're much more comfortable in identifying types of investments that have maybe less upside potential, but certainly provide equity-like returns with the associated downside protection of credit investments. And this is really what distressed investing is about. It's about finding value across a company's balance sheet, not just in the equity, but particularly in periods of distress. And for me, as I said, buying a distressed asset at a discounted price is a lot better than paying a premium, or paying too much, I should say, for a premium asset. Howard Marks from Oak Tree Capital is a mentor of mine and someone I follow very closely. He likes to talk about the Nifty 50, where when he started his career, the 50 best companies in the world were trading at 80 to 90 times multiple of earnings, and then just 2 years later, those same companies were trading at 8 to 9 times earnings. So investors that had gone out under the pretext of investing in the best companies in the world had lost 80 to 90% of their capital in those investments. So that's clearly not what we do. In a stock market that we'll talk about here in a moment that's valued at 26 times earnings against historical means of 15 or 16 times, we're not looking for opportunities or investments in that realm. There's always distress somewhere, and what we're looking for is risk-adjusted, again, or discounted prices for distressed assets. That's what I've done at ILEX. We had a run of buying bankrupt companies from 2007 to 2013 that was very successful, and that's what my partner Randy Durig has done with his fund Distressed Debt 1, which last year, in a year of climbing stock prices, was one of the top 10 hedge funds in the United States out of more than 9,000 buying distress. And last year it was materials and energy, and this year will be something different. But the common theme is always risk-adjusted, discounted prices for high-valued assets. It's a specialty strategy, and you can see on the slide here that the strategy has outperformed the market for the last 25 years. It hasn't always been a particularly crowded trade. There's always folks that'll rush into the distressed markets at the point that the opportunities exist. But over time, what the data would suggest is those that are earliest in committing to the strategy are most often able to capitalize in the most meaningful way in periods of credit dislocation. But nonetheless, the strategy has outperformed virtually every index, whether it be the S&P 500 or just global U.S. Corporate high yield indices. So for us, what is the process behind that strategy? Well, it's predicated on three key points, or three legs to the stool, if you will. First, we target distress, or markets that we would characterize as being inefficient. We seek markets where sellers are not always rational, targeting dislocation, or what we call price gaps, when there might be abundance of sellers, like I mentioned in the credit crisis. Pension funds and CLOs and insurance companies often are not able to hold the type of securities or credit instruments when they become downgraded or appear to be entering into a restructuring. They just don't have an appetite for participating in that process, and they become forced sellers. So the price gapping, as we call it, around those type of opportunities, and what happened in energy last year as well, are always something that we are targeting. We also seek markets where there's some element of seller friction. We don't like auction processes or exchanges. Equity exchanges have become very efficient and harder for investors, or at least harder for us to identify value. So we're looking for inefficient markets with some element of seller friction. The second element to our strategy is that we're comfortable with complexity as a means to bring down the price of the assets that we are buying or the securities that we're purchasing. Whether that complexity manifests itself into bankruptcy, which is in itself a complicated understanding, whether you're trying to understand jurisdictions or judges or the entire environment around bankruptcy, it's a particular area of competency that we have come to develop. We have attorneys on staff that assist us with that, and it's an area where we are comfortable and can understand value because of it. There's also opportunities to have an information advantage around things like credit agreements, which are often complex, 300-400 page documents that have various entitlements that need to be understood. The other area that distress is often accompanied by isolated operational issues. I'll give you an example there. Johnson & Johnson, who was a stellar company, obviously, was selling off a particular subsidiary after a product recall. And we would look at assets in that environment, understanding that not oftentimes the baby is thrown out with the bathwater. We purchased a little brand called St. Joseph aspirin after a product recall from J&J, and we were able to move the manufacturing and develop a level of confidence with both customers and retailers with that brand after the recall. And again, I use that as an example where we can come into a situation where there is a level of hair on the deal and identify and capture value. We then went on to sell that to a private equity buyer after it was back into the market. And that dovetails to the third element of our strategy, which involves identifying those companies where we believe there's a catalyst for value creation in a restructuring, or in the cases I just described, an operational improvement. When a company comes out of bankruptcy, it's typically either debt-free or capitalized in a way that it can really focus on the operations of the business. And many times this focus, taking the shackles off of management, can really create value. And we look for those situations. And in the cases where we are able, we help facilitate that improvement in the companies that we are invested in. Also, in many cases, companies can create value subsequent to a restructuring process by selling off or disposing of assets or subsidiaries to create value. The sum of the parts trades at a premium to the level of which we invested, and we are looking for those opportunities across our investments. And what you'll find is all of these factors together for us create investment opportunities that are intended to provide equity level returns with much lower credit style risk. These are also areas where hard work tends to manifest itself and pay off. We don't necessarily have to be the smartest guy in the room or the smartest investors in the room or the luckiest, but we feel like that if we do our work in these areas, we can create returns in a meaningful way with less risk, and this style matches the skill sets of our partners and our employees. So tactically, how do we execute that strategy I just described? Well, in short, we're looking for misappropriations of value within corporate balance sheets. Now that sounds like a mouthful, but more more sort of succinctly, what we're looking for is a seller, for example, of a banknote. I mentioned the United Airlines example, but the most secured element of a company's balance sheet, bank loan that might be trading in distress because whoever the seller is not again able to hold it because it enters bankruptcy, or they just don't want to, or the company is in a secular headwind where there's just many more sellers than buyers. But however we acquire it, we're looking for a loan, for example, that might be a $100 million term loan, but secured by assets that have a value that significantly exceeds that. Maybe they have a $100 million term loan and a $500 million value of those assets, and we can buy that banknote for 30 or 40 cents on the dollar. Now, realizing that we can only realize that value or the associated collateral value subsequent to a restructuring, or once the path to the restructuring is visible. But if we see that opportunity, that is the type of area that we are investing in. Or I'll use an example of a secured bond, which is not at the level of seniority of a bank loan, but oftentimes a secured bond will be converted to, or a portion of that secured bond will be converted to equity or ownership of a business at an attractive price point. Give you an example of that. We bought bonds in a company that we knew was going to be converted to equity, where the company post restructuring would have about $150 million in debt service or debt load, but the company's generating $50 million in cash flow, so it's levered at 3 times that cash flow, and the subordinated bonds were getting 100% of the equity, effectively issuing or selling the business at 3 times cash flow or 3 times EBITDA in a market where many of its peer group was 8, 9, 10 times multiples of cash flow. So allowing us to buy the bonds at significant discounts to the converted or restructured equity. In that particular case was Quicksilver, which is a retail clothing company, and people might cringe at the notion of retail, but Quicksilver is a company with brands, high value brands that sell internationally. The bankruptcy allowed Quicksilver to close many of the retail outlets and focus on their distribution within other channels. So it's an example where if you can identify the path forward for a company, buy in at a attractive valuation level with a high level of security, and take ownership of a business that can be very attractive. So, and that's really the type of analysis across a firm's balance sheet that we are seeking to capture value, acquiring securities at a discount to value, facilitating that catalyst to create incremental value, whether it's a restructuring or some type of asset sales I described earlier, and then exiting those investments as they move towards longer term viability and exiting them at fair market values rather than in a distressed environment, which we often are buying them within. The opportunity set for opportunistic credit investing is obviously driven by the amount or the issuance of corporate debt, which, a secret to no one, has ballooned over the last several years. The market for high yield credit, which is where the lion's share of our opportunity is initiated, was a $250 million, a billion dollar, or $1 million market in the 90s, or as late as 1997, and today sits at over $1 trillion, with leverage in every sector over the last several years on the increase. So that in large part drives our opportunity set, and where companies invest their capital will oftentimes arrive upon the default cycle. If you borrow and invest correctly, you can create value. If you borrow capital and your capital allocation strategy involves areas that don't create value, that's when we move towards a higher level of corporate defaults. And if you look at the last several years, corporations have been investing a significant portion of their income as well as their borrowings on share repurchases and dividends as opposed to business investment. And we think this is it manifests itself in a number of ways. One, obviously, it has had a positive impact on equity valuations. Share prices as a multiple of earnings, according to Case Shiller here on the slide, have only been this high in 1929 and 2000, both ominous periods. But companies investing their capital to return to purchase shares and to return dividends to their shareholders have initiated a flight towards equity over the last several years and driven valuations. But what we're seeing as we look across the markets, as the growth in debt has not necessarily kept up with the growth in cash flows, and this is historically been a trend which precedes a default cycle. When growth of debt has exceeded growth in cash flow, it just reflects a misappropriations in corporate capital allocations that present opportunity for firms that are able to capitalize upon it. So in looking at that strategy, I mentioned earlier that when we look across the corporate credit cycle and evaluate the periods when the strongest returns were available, there were a couple of important takeaways. First, important to point out that returns were available across the credit cycle. And secondarily, it's also important to note that historically, the best returns have gone to those investors who have deployed capital earlier in the cycle rather than late. You're much better served, as you can see on those small bar charts, to have your capital deployed earlier rather than try to catch the bottom, or to be late in making investments on the way out of a credit contraction. And that dynamic happens for a number of reasons. For example, on the daily ACTS sheets that I was referring to earlier, many of the highest returning trades occur prior to restructuring events rather than post-restructuring or in the bankruptcy process. That often it's often at that point it's often too late to capture optimum returns in these type of environments. So I would tell anyone that is considering the opportunistic credit investment class that it is smart to deploy capital early, dry powder, as they say, in place to get ready for a downturn, as opposed to reacting to a downturn after it already presents itself. And with all of that said, as you seek to find a manager to deploy capital in this space, the final considerations I'll leave you with today involve selecting a manager in the distressed credit arena that has the appropriate expertise, mandate, and structure to be successful in this area of specialty. Expertise is rather self-explanatory, but finding managers that are comfortable in identifying winners and losers in often turbulent economic environments is not easy. But those that have a track record are obviously a great place to start. It's also important to identify managers that have an appropriate mandate that allows them to be flexible enough to capitalize upon what are sometimes rather diverse opportunity sets, whether that's globally or sector wide. The opportunities share common themes, but they often find themselves in diverse industry groupings. I think it's also proven to be very valuable to invest in funds with a structure that's closer to a closed-funded private equity structure, as opposed to a more liquid hedge fund structure. The pseudo private equity structure allows the manager to work, I think history would show, in distressed environments in a way where they can realize the full value of their investments over a managed time period, rather than having LP selling pressure come in at the wrong time and manipulate or force them to sell positions that are difficult or lack liquidity in a restructuring environment. For example, in a market downturn, when you're looking for blood in the streets, this structure just effectively protects one investor or one limited partner from another limited partner, as I said, and not putting selling pressure at just the wrong time. The final element of a more pseudo private equity structure is that the manager has the opportunity but not the obligation to invest. You don't want your manager being fully invested coming into volatility, a structure where there is capital calls, where the manager is deploying capital as opportunities present themselves makes a whole lot more sense. So with that said, I certainly, and I think most of you would agree, that these are very interesting times, economically, politically, in a number of different areas. And as an investor, it's certainly hard to go wrong over the last several years, as I mentioned, 8 years into a bull market cycle. But I really believe at this point, and I'm not the only one singing these songs, that along with a number of other investors like Alan Greenspan and Carl Icahn, just to name a few, that history will show that excesses in a number of markets, and today we talked about the corporate credit markets, but excesses in those markets will have a large part to play in defining the path of our markets going forward, and alongside that, defining your investment returns. And for those investors that are positioned correctly and understand the consequences of these market reactions, have the opportunity to do really well and come out of the other side of this reversion to the mean, if you will, in a meaningful, stronger position. And it was my hope to convey that to you today. I appreciate the opportunity to speak to you all. Thank you very much.